calls accounting the language of business and notes that it's a vitally important skill for investors and business people to learn. Yet the sad truth is that 95% of business people can't read financial statements. That's like being a professional musician, but not knowing how to read music. In this video, I'm going to explain all the basics of how to read financial statements in under 10 minutes. Hi, my name is Brian Feraldi. I'm a financial educator who has been analyzing and investing in individual businesses for more than 20 years. But the clock is ticking, so let's get started. So what are financial statements? They are reports that summarize the activities and financial performance of a business. They're produced by companies at the end of each accounting period, which is typically a quarter or year, and they give managers, investors, and lenders an overview of the company's financial health. Now, there are three major financial statements. They are called the balance sheet, income statement, and cash flow statement. Each statement is designed to answer a specific question about a company's financial position to give readers a more complete view of its financial health. Now, in this video, I'm going to show you some fake financial statements of a business that I created called Best Coffee Company. Let's start with Best Coffee Company's balance sheet. This is a record of what the company owns and what it owes to others. The balance sheet answers the question, what's your net worth? And is kind of like your own personal net worth statement. The balance sheet has three major components: assets, liabilities, and shareholders' equity. The balance sheet is ruled by the master accounting equation, which states that assets must always precisely equal liabilities plus shareholders' equity. This equation must always be in perfect balance, hence the name of the balance sheet. Now, an important thing to know about the balance sheet is that it is a point-in-time snapshot of what a company owns and what it owes. Think of it like somebody taking a picture of a company's net worth. That's why whenever you see a balance sheet, it always has a specific day associated with it, which is the date that the picture of the company's financials were taken. Let's take a closer look at each of the three major categories, starting with assets. Assets are everything that the company owns that has value, like cash, inventory, and buildings. Assets can be further broken down into two major subcategories. The first is called current assets, which are all assets that the company expects to use or utilize in less than 1 year. This includes things like cash, receivables, and inventory. The second category is called long-term assets, which are expected to benefit the company for longer than 1 year. This includes things like buildings, equipment, patents, and goodwill. The second major component of the balance sheet is liabilities, which are debts and payments the company owes to others, such as suppliers, employees, and lenders. Liabilities can also be broken down into two subcomponents. The first is called current liabilities, which are bills that are expected to be paid off in a year. This includes things like payables, accrued expenses, and short-term debts. The second subcategory is called long-term liabilities, which are bills that are expected to be paid off in more than a year. This includes things like long-term debt, convertible, and pension obligations. The third major component of the balance sheet is called shareholders' equity, which is what the company owes to its owners or the shareholders of the business. Think about this section as a company's net worth on paper. There are two major sources of equity. The first is capital that investors put into the business to get it started and fund its operations. This includes things like common stock, preferred stock, and paid-in capital. The second major source of shareholders' equity is profit the business generated but did not pay out. This includes things like retained earnings and treasury stock. Now let's move on to the second financial statement, the income statement. The income statement shows a company's revenue, expenses, and profit. It answers the question, are you profitable, and is similar to your own personal monthly budget. The income statement is measured over a period of time that has a start date and end date. So while the balance sheet was more like a camera, think of the income statement more like filming a movie. There's a start time and there's an end time to it. Now, the top line of the income statement is revenue, which is all of the sales a company makes during a period. From revenue, we subtract out all of the company's various expenses as we work our way down the income statement. Expenses are broken down into four major subcategories. The first is called cost of goods sold, which is the direct cost to manufacture the product or deliver the service. The second is called operating expenses, which include all overhead expenses of the business, such as salaries, research and development, and selling. The third major category is called non-operating expenses or income, and usually relates to things like interest paid or interest received. And the fourth major category is income taxes, which are taxes paid to state and local governments. Now, as we work our way down the income statement and subtract expenses, we get various forms of measuring profit for the business. The most common way to measure profit is the bottom line of the income statement, which is called net income, aka earnings. This is the total amount of profit a business generates after subtracting all expenses. However, there are also other ways that we can measure profit depending on what we subtract from revenue. For example, gross profit is revenue minus the cost of making the product or service. Operating income is revenue minus the cost of making the service and operating expenses. The final way is pre-tax income, which is the company's earnings before paying income taxes. Now, below net income, we have the total number of shares that are outstanding for a business. This represents all outstanding stock that are owned by shareholders. And the final number on here is earnings per share, which is the total claim that each individual share has on the company's profit. Now, it's important to understand that the income statement is created using accrual accounting. This means that revenue is recorded when it is earned and expenses are recorded when they are incurred, regardless of whether cash changes hands. There are a wide number of reasons why the timing of earning revenue and incurring expenses doesn't align with the exchanging of cash, such as making a sale on credit. However, it's really important that a company tracks the flow of cash through the business, which brings us to the third financial statement, the cash flow statement. The cash flow statement is very similar to the income statement. However, the cash flow statement focuses on the question, are you generating or consuming cash? Like the income statement, the cash flow statement has a start time and an end time. However, while the income statement used accrual accounting, the cash flow statement uses cash accounting. So when recording revenue, the only thing cash accounting cares about is, did the cash get received? And when recording expenses, the only thing cash accounting cares about is, was cash paid out? The cash flow statement can be broken down into three major subcategories. The first is called operating activities, which are all activities related to running the business. The second is called investing activities, which are all cash flows related to investing in the business. And the third is called financing activities, which are all cash flows related to financing the business. Now, the very top line of the cash flow statement is net income, which is taken directly from the bottom line of the income statement, showing one way that these financial statements are linked together. Now, from net income, we first have to add back in all the various sources of cash inflows that a company could have. These could be related to non-cash charges, changes in working capital, selling investments, issuing debt, or issuing stock. We next have to then subtract out all the various cash outflows that a business could have, which come from things like changes in working capital, capital expenditures, making acquisitions, repaying debt, repurchasing stock, or paying a dividend. From there, we take the total changes in cash from each of the three major categories, add them together, and that gives us the total change in the cash balance during the period. We then add or subtract that from the cash we had at the start of the period, and that gives us the cash at the end of the period, which is the very first number on the balance sheet. Now, I just threw a lot of information at you, so let's quickly summarize what we just learned. The balance sheet records what a company owns and what it owes. It's similar to your net worth, is a point-in-time snapshot, and it uses accrual accounting. The income statement purpose is to show a company's income and expenses. It's similar to your personal budget. It's measured over a period of time, and it uses accrual accounting. The cash flow statement tracks cash movement through a business. It's kind of like your personal checking account. It's measured over a period of time, and it uses cash accounting. Now, it's important to understand that not all companies use these exact terms and layout when they're making financial statements. For example, you might see the balance sheet referred to as a net worth statement, the financial status report, or the statement of financial conditions, and each individual term you see on the balance sheet might be called something else. The same is true of the income statement, which is also called the earnings statement, statement of operations, or even profit and loss statement. And each term you see on the income statement might also be called something else. Now, to make these terms a little bit easier to understand, I created a free accounting infographic ebook called Financial Statement School. Now, if you go to longtermmindset.co/FSS ebook, or click the link in the video description, you'll be taken to a page where you can download a free copy of this ebook. I hope this video was useful. If so, give it the thumbs up and let me know below if you want to see more content like this.